Okay, we are now in the middle of step 8 in completing the steps in the accounting cycle. Financial statements are prepared. Now, this is not the first time you've seen these, you guys. Remember, we did a set back in chapter 1, and they're not that much different. The income statement, as you saw, was almost identical. The retained earnings statement will be as well. You'll see a few changes, though, in the balance sheet. So let's start back with the retained earnings statement. Notice we've completed the income statement on the last one. Now, on the retained earnings statement, we want the retained earnings balance as of April 1st, 2013, which would have been the beginning of our year. And we'll pick up that number from here. It has not been updated for net income or for dividends for the current year. So we'll start with a $70,000 balance. That was the balance to begin the year. Okay, now we want to add to that our net income for the year, $51,150 from above. Right here, $51,150. Now we will deduct dividends. We'll pick those up from here. Our dividends for the year were $15,000. Less dividends, $15,000. Okay, now notice net income was, remember, net income increases retained earnings, dividends decrease retained earnings, and in this case net income was larger. So when we net the two together, we're going to have an increase in retained earnings for the difference in these two. So I'm going to say $51,150 minus the $15,000. That gives us $36,150. Now, to get our retained earnings balance at the end of the fiscal year, we'll take the beginning balance plus the increase, and that'll get us to our balance at the end of the year. So $70,000 plus the $36,150. So it's $106,150 is our ending balance for retained earnings. Okay, now we'll go to the balance sheet. That looks a little different than the one you did back in chapter 1. We still have the asset section, the liabilities section, and the stockholders' equity section. But where you're going to see a difference now is in the asset section and the liability section. Under assets, we now have two categories of assets: current assets and property, plant, and equipment. Current assets, you guys, would include cash and any other asset that you expect to use or convert to cash within one fiscal year. So cash and any other asset that you expect to use or convert to cash within one fiscal year. Okay, property, plant, and equipment is fairly self-explanatory. Those will be assets that will benefit more than just the current fiscal year. And they include things like buildings, land, equipment, things of that nature. Any depreciable assets would be included here, or assets that we depreciate. Now, current liabilities will be liabilities that we pay out of current assets within one fiscal year. Okay, so let's start with current assets. Remember, I said they include cash and any other asset that we expect to use or convert to cash within 1 year. So cash will definitely be included. We'll list them in order of liquidity, or the easiest to convert to cash first. So cash would be listed first. Now let's go back up to the adjusted trial balance and pick up its balance. Cash is a balance of $12,000. Okay, let's look on our adjusted trial balance. Our other current assets are ones we'd use or convert to cash within 1 year. Well, we're not stockpiling supplies for 5 years, you guys. The supplies we have at the end of one fiscal year would be used within the next year. And then we're probably not paying our insurance ahead for more than 1 year. So the prepaid insurance balance at the end of 1 year would expire during the next year. And we would consider supplies to be more liquid than prepaid insurance. We're probably not going to try to convert either one to cash as long as we stay in business, but it'd probably be easier to sell our supplies than it would to try to get our premiums back from the insurance company. So supplies is $7,500, prepaid insurance $1,800. Okay, now we want to total those. Our total current assets would be equal to 12,000 plus 7,500 plus 18,000, and that comes out to 21,300. Okay, then next we'll list property, plant, and equipment. We'd pick up any buildings, land, equipment, land, and any other assets that we depreciate. Okay, I don't believe we have any land in this problem. Let's go back and look at the adjusted trial balance. After prepaid insurance, we do have equipment and trucks. And we're going to list those in the property, plant, and equipment section, and we're going to pair them with their accumulated depreciation accounts. So equipment is a $110,000 balance. Let's pick up its accumulated depreciation, or the accumulated depreciation on equipment is $33,350. You don't have to put dash equipment here because we're pairing it with that account on the balance sheet, so the readers would know that it goes with the equipment. Okay, hope that makes sense. We normally, on the adjusted trial balance and in the ledger, we'd put accumulated depreciation dash equipment. That'd be overkill here because we're pairing it with the equipment account. $33,350. Okay, now we're going to take the difference in these two and list it over in the second column. We'll call that difference book value. Cost minus accumulated depreciation is called book value, and that's the number we would use in calculating a gain or loss if we sold this equipment. And it's the number that gets included in total assets down here. Okay, so it's going to be equal to 110,000 minus the 33,350. It gives us 76,650, the book value of the equipment. Okay, next, I believe we're going to pick up trucks. Let's see what's next. Yes, trucks. 60,000. All right, then we'll deduct the accumulated depreciation on the trucks. Accumulated depreciation trucks is $21,200. Again, we don't have to put dash trucks because it's paired with the trucks account here on the balance sheet. Then we'll take the difference in these two to get the book value of the trucks. So it's equal to 60,000 minus 21,200 gives us 38,800. That's the book value of the trucks. So for instance, if we sold all of our trucks for 40,000, we'd have a $1,200 gain on the sale of the trucks. Even though they cost 60, we've used the trucks for a while, and the depreciation that is accumulated on them totals 21,200. Okay, next we want total property, plant, and equipment. We'll get that by adding together our two book values. So it's equal to $76,650 plus $38,800, $115,450. Okay, next we want total assets. And we'll get total assets by adding together total current assets and total property, plant, and equipment. So total assets is equal to 21,300 plus 115,450, 136,750. And we hope we will get the same number over on this other side once we finish the other side of the balance sheet. Okay, next, you guys, we have liabilities. Remember, I said current liabilities will be liabilities that we expect to pay out of current assets within one fiscal year. We could also see long-term liabilities. Those would be liabilities that get paid sometime beyond 1 year. Like if we borrowed money from the bank and we intend to pay that back over the next 5 years. The part that we'll pay back within 1 year would be a current liability. But the part we'd pay back years 2 through 5, the principal portion there would be a long-term liability. However, in this problem, we only have current liabilities. So total current liabilities will give us total liabilities. We won't total them separately. So let's look for our current liabilities. Those will be ones we'll pay within 1 year. Well, accounts payable, our vendors would be pretty upset with us if we did not get them paid within a year. Usually we have 30 or 60 days to pay vendors on account. So accounts payable is 4,000. We'll also pick up wages payable, which is 600. We'll definitely pay our employees before a year is up. Wages payable. $600. And then we want total liabilities, and I can just do that in my head, $4,600. Okay, then for stockholders' equity, we're going to pick up our capital stock balance, $26,000. And we'll also pick up retained earnings. But you guys, a common mistake here would be to go back up to this adjusted trial balance and pick up retained earnings as $70,000. But remember, that was our balance to start the year. This number has not been updated for the current year's net income and dividends. So we want to pick up our retained earnings number from here. We want retained earnings as of March 31st, 2014. It matches our date on the balance sheet. So we want to pick up retained earnings, $106,150. And now we'll add those two numbers together to get total stockholders' equity. That's $132,150. Okay, so now we've got total stockholders' equity. We've got total liabilities. We add those two together, that'll give us total liabilities and stockholders' equity. $136,750, which matches total assets. Okay, you guys, so now we have completed Step 8 on the steps in the accounting cycle. Financial statements are prepared. And in the next videos, we'll move forward with steps 9 and 10. Thank you.